Hello, welcome to Fininvest Niger. My name is Tom Princeville. I'm a certified investment and securities specialist, and I've been investing for the past 20 years. In the course of this video, I want to talk about a rather controversial topic, and that is passive versus active investing. In other words, individual stock picking as against index investing. And I want to equally consider the pros and cons of these different kinds of investing, these different investment strategies. When I talk about individual stock picking, it involves you as an individual picking individual stocks, picking different stocks from the stock market, after thorough research. Whereas index fund investing, in this case, the fund manager simply picks an index. It could be the overall index of the stocks in the market. It could be, sectoral index, like the banking sector index, like the consumer good index, insurance index. There are a number of them I've discussed in one of my videos regarding index funds. So when it comes to individual stock picking, I want to highlight the merits, the advantages, or the pros of this particular strategy. You discover that there's always a potential for higher returns. If you have the skills, you have the capacity, the ability, the talents to be able to pick individual stocks, you will have an outsized returns at the end of the day compared to merely investing in an index fund. You could even double your investments, your investment portfolio at the end of the stipulated period. So there's always that capacity for an outsized returns. You equally have you have a more central control over what you buy. You have the control over what you buy or sell, when to buy or sell. Your individual stocks. You are the commander of your investments. You're the captain of your investment ship. You do everything yourself, and of course, you bear responsibility yourself. As the case may be, there's that individual control over what you buy and over what you also sell in the market. There is a learning opportunity about business. Someone said, I am a better investor because I am a better businessman, and because I'm a better investor, thereabout. So once you are into individual stock picking, you face it the way you face a personal business. There's always that particular loss gain situation. You have your result at the end of the year to consider, your losses as well as your gain. So investing itself is not just a leisure activity, it's a serious business on its own. And so it gives that particular learning up. You have that opportunity to learn even as an investor. There's an opportunity to get to know the market better. It takes time to be able to obtain the knowledge. It's something worth obtaining, because at the end of the day, it will give you an edge, in this particular craft as an individual investor. You equally have that ability to tailor your investment to suit your personal values, the moral values, ethical values. So you pick stocks based on your belief. You may avoid stocks, maybe the defense industries, maybe tobacco stocks, and it could be breweries, companies. You really invest in them based on your personal belief and moral framework. So that particular choice of what you want to invest in and what you want to avoid is inherently yours as an individual stock picker. And not only that, there's that particular, it offers a certain indescribable level of fulfillment. That is, at the beginning of the year, as the case may be, you pick a number of stocks, probably 5 or 10, 15 or 20, as the case may be. If you are able to beat the markets at the end of the year, you have that psychic kind of fulfillment that, yes, I've been able to achieve something that the majority of investors in the market have not been able to obtain. So it gives that particular sense of joy. It's a typical advantage that is considerable, as an individual stock investor or stock picker. Then let's look at the cons, the disadvantages, the demerits of individual stock picking. Number one is higher risk due to volatility. The markets always fluctuate. Somebody asked JP Morgan, that prominent American banker, what do you think the stock market will do in the future? And he answered, it will fluctuate. So fluctuations in the markets is an inherent part of the market itself. And so when it fluctuates downward, you tend to secure or sustain that paper losses. And when it fluctuates upward, you have that particular paper gain. Of course, you don't really realize your gain or loss except you sell. So there's that particular natural tendency for the market to swing up and down. The market is always volatile, and the volatility, it may present a risk if you sell. But if you don't sell, it becomes like a buying opportunity. When the stock goes down, you have cash available. You could buy decent, strong companies, excellent companies with strong balance sheets, fortress balance sheet at a cheaper rate because of the natural fluctuations in the market. And another disadvantage here is it requires time, research, and discipline. It takes time to be able to master the market. If I talk of a personal experience myself, I've been investing for the past 20 years, as I told us earlier. And for the past 20 years, I've just stated, it took me about 11 years to fully master the market, probably because I'm a slow learner, but it took as much as 11 years to be able to fully master the market. So it takes time, and it might take daily research. When people are scrolling through TikTok and having fun and watching football and other things online, you'll be there researching companies, researching the markets and see how you can gain an edge, when it comes to mastering your craft. So it takes time, it takes discipline, and of course, you tend to research almost daily. That's another disadvantage not everybody will be able to subscribe to. Number 3 here is emotional decision can hurt. It can hurt you. It can hurt your portfolio. Generally, human beings are not all that logical when it comes to investing and other spheres of life also. Discover that at a point in time, there could be a general drop in the value of stocks in the market, and you'll be tempted to sell. All right, so it takes real strength, inner strength of character to be able to not give in to the prevailing market condition and sell your stock when you ought not to sell. So in this case, it takes there's a particular tendency to key into or to give into emotional decision making as an investor. You don't allow your emotion to rule you. You make sure that you are really rock solid when it comes to decision involving the markets. And most investors unfortunately underperform the markets. Most investors, in fact, a majority of the investors don't beat the market. It takes years of experience. It takes a heightened level of capability, skills, dedication, to be able to beat the markets. And you may not even be able to beat the market consistently, but all the same, it's an activity worth getting involved in. So most investors, in an actual fact, don't really beat the market. That is just what statistics tells us, and of course, it's true. All right, and so these are the cons involving individual stock picking. And of course, I've equally earlier discussed the advantages. Now, I want to talk about the index fund investing. When it comes to index fund investing, it's very easy, straightforward. Simply buy an index. You could buy the insurance index, you go and rest. You can buy the banking index, you just go to sleep. You may decide to put your money in consumer good index. Particularly this last year, 2025, the consumer good index did exceptionally well. Just invest in those index and you go and sleep. You go and rest. No individual effort, no research, no emotions attached to any investment aspect. Just simply buy and go and rest, and then the market itself, the index itself, generates returns for you. So that is what it's all about. Now, the process is that there's instant diversification across different companies. When you buy an index, if you buy the banking index, they invest in virtually all the banks, in the banking sector. You buy an insurance index, they invest virtually in all the insurance companies in the insurance sector. So all the sectoral indices, they invest, in virtually all the major stocks in those sectors. And if you are buying an entire market, like the market index, you are buying virtually the whole number of stocks that makes up the entire NGX. So in that case, you are able to secure a heightened level of diversification, and your risk, is considerably lowered, as an investor. And the other one is, this lower risk compared to individual stocks, because you are fully and highly diversified. Your risk level is relatively lowered compared to you picking individual stocks. Maybe you're just buying maybe let's say 5 or 10 or 15 stocks, compared to buying an overall market, the entire market, or a complete a sector or sectors as the case may be. In that case, because of the level of diversification, your overall risk is quite minimal. And then you have there's a history of strong long-term, overperformance. On a long-term basis, the index funds tends to beat individual stock picking, particularly if the individual is not all that capable, doesn't really have the skills, involved in making headways or having, outperformance with this particular strategy. So over a long-term basis, index funds tends to beat individual stock picking. And not only that, there's it's easier to stay disciplined during market swing, the inherent market swing and fluctuation, because we're not really attached to any given stock. So when the market swings as expected, when volatility takes place as expected in the market, you're not touched, because number one, you don't really pick the stocks individually, and number two, the fund manager handles your investment for you, so you don't really bother about anything. There's no emotional decision making involved in the entire process. That's an advantage that is very, very important we consider when it comes to individuals, when it comes to index fund investing. That's something that is very, very prominent or common with this form of investing. And not only that, it's easier to stay disciplined. Whenever the market swings, you don't display emotion, because you are not personally touched, because you were not the one that really picked the stocks in the first instance. You only buy, you simply bought the index, and the index does its work for you. Now let's consider the cons, the demerits of this strategy. You need to consider as an investor. In this, there's no chance to significantly outperform the market. You have no chance at all of outperforming the market, because you are tied down by whatever result the index gives you. If the index produces 20%, 30%, 40% for that particular period of time, maybe for that particular year, you take it. You are a returns taker. You can't really manipulate your way, or display a level of skills that will help you to beat the market. No. Whatever the market gives you is what it takes. If the market is high, you enjoy a heightened return. If the market is low, you endure minimal returns. So you have no individual contribution at all as far as a result is concerned. And then there's that limited flexibility in stock selection. In this case, your universe is somewhat restricted. If you are buying the banking sector, the banking index, so you are stock picking, the manager will only pick stocks that are within the banking sector. If it is the consumer goods index you are buying, the fund manager will only buy stocks within the consumer good index. So in that case, there's a particular limitation as it relates to stock selection. It's a disadvantage that is somewhat prominent, and we can't afford to ignore. There's in this case, returns are tied to overall market performance. As well as earlier, you cannot beat the market in this. You cannot really outperform the market in this regards. Whatever the market gives you is what you are going to take. This particular year, I think the market made around 50% or so last year. So that's what you will take. You can't go higher and you cannot come lower. But if you are an experienced stock picker, you can even double your money in the markets. But as an investor in index fund, you only take what the market gives you. Please subscribe to this channel, and don't forget to like this video and share this video. help me reach out to 1 million Nigerians with the message of investing. I want others to come and really get to like enjoy, the benefits of investing in the Nigerian market. Please help me in this regards. Now, I want to see precisely the nature of individuals that should adopt index investing. If you want long-term wealth creation with minimal stress, you don't want stress, you don't want the emotions that comes with volatility, you cannot really bear risk, you don't have risk appetite, you're the kind of conservative investor, you don't want anything that will give you sleepless nights, then the index fund is for you. If that's your goal, I will advise you you go with index fund. But if actually you want to learn, you want to get in, kind of immersed in the investment process, it's quite engaging, quite all right, and you want to really get involved in the risky aspect of stock selection. It gives you that adrenaline drive, and you have a desire to kind of outperform the markets, then stock picking is for you. All right, stock picking will play a role in you outperforming the market. But I must stress the fact that stock picking isn't a game, isn't an endeavor for beginners. It's for experienced people who have been in the market for a long time. Just like I earlier told us, it took me about 11 years, 11 good years to really master the markets, and probably because I'm a slow learner, but that is just a range, within which it take you to kind of understand precisely what the market is all about. But once you understand that, I'm telling you, you will enjoy that particular skills, for the rest of your life as an investor. Please stay connected to this channel for my next video. And if you're not really comfortable with both, you don't really like the individual stock picking, and you're not really comfortable with the index fund kind of a thing, then I will advise you go for the hybrid side. All right, you do a little bit of, maybe you may put in probably 60-40 strategy, 40% in index, in individual stock picking, and 60% in index funds. You could vary the ratio depending on your risk appetite. Okay, so you can adopt a kind of hybrid kind of investing. You are an index fund investor, and you're also an individual stock picker. But me personally, I'm kind of biased. I prefer individual stock picking. The joy of beating the market is something you cannot actually quantify. So take the time to learn, and once you get the skills, you will enjoy it all through life.